Hey there, everyone. Today on the final bar, nice rebound day for the equity averages. The XLY, the XLK, consumer discretionary and technology at the top of the sector list. We'll dig a little bit into breadth indicators today. Which market breadth indicators can help us identify a potential market bottom? We'll also do a segment called It's All Relative. Which stocks deserve your attention during a market pullback? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The technical toolkit is really designed to help you appreciate the message that this market sends back to you in the form of price action. I often get questions about how to use different technical indicators, how you use different sentiment indicators just to understand what investors are thinking and what they're excited or nervous about. I would argue price is the main thing you should be looking at to answer all of those questions. Price is based on buyers and sellers coming together. Price is what moves when people get excited or nervous or panicked or desperate or euphoric or overly optimistic. Price will move in reaction to that. So it's great because it's not based on what people say they might do or think they might do. It's what they're actually doing with their capital. When people get excited, they tend to push prices higher. When people get nervous, they tend to push prices lower. And that has been the story of equity investing, I would argue, from the beginning. Now we just have great data and analytics to try to appreciate those lessons a little more easily. Today we have the market rebounding to the upside, a nice little rebound move with some of the growth sectors like consumer discretionary and technology kind of popping higher. The question is this just a brief bounce, a pump fake of sorts before we rotate and continue this downtrend? Let's look at the market recap and see what sort of lessons we can draw from the markets today. Before we get there, do want to answer a poll question. Where will Apple be 1 month from today? At least 10% up, at least 10% down, or somewhere in the middle? And what's usually happened with these questions, you kind of have the cluster of responses around the middle. I don't disagree with that. If I was asked where do I think Apple will be 1 month from today, or most stocks, it's hard to think about an objective over 10% in either direction just because there's such an indecisive feel to the tape right now. Let's look at the charts and see what we can actually see where those 10% levels are. By the way, if you're trying to do this on your own, on Sharp Charts and ACP, similar tools, they're just in different places. On our Sharp Charts engine, click on the little annotate button below the chart, go to the little note icon, go down to percentage change. You can click on the current price and then move 10% up. I'm kind of just gaming it here really quick just to be brief about it. 10% down kind of takes us in that general range. So basically, a 10% rally would take us to retest the August peak around 190. A 10% drop would take us well below the 200-day moving average, down around 156, 157. That would really continue this process of retracing back to those previous lows. I would probably opt for between 0 and 10% lower. And the reason why I would say that is because this downtrend appears to still be in play, and the fact that we're making lower highs and lower lows. So as long as that trend continues, the price is going lower. The 200-day moving average often serves as potential support because a lot of long-term investors will think of that as one of those major, long-term barometers, right? As long as we can hold the 200-day, things aren't getting that bad. So you often assume some sort of a bounce here. So the question is just how long a bottoming sort of, period could take. I think it'll take through a month, to be honest with you. I wouldn't be surprised if at the end of October we're not too far from current levels. It can be a noisy ride from here to there, and that's one thing to keep in mind with any of these questions. Thanks for answering those polls, by the way. The way to see those polls, 2 answers. Number 1, follow us on social media, on Twitter, X, Facebook, wherever else you can see stock charts. And also just subscribe to our YouTube channel. Through YouTube, you can get some of the notifications for our poll questions as well. Continuing our market recap, let's look what happened today. Nice sort of rebound after yesterday's distribution. You have the S&P 500 up 0.8% to 4264. We'll call it just slightly below that. The NASDAQ composite up 1.4% to 13,240, just slightly below that. NASDAQ 100, the best performer out of the bunch here, up almost 1.5%. So, almost doubling the up day of the S&P 500. So we're back to sort of that mega cap growth leadership that we've reviewed previously in 2023. Mids and smalls all up as well. The small cap index only up about 0.3%. That usually happens when growth sectors are at the top of the list. They're a little less weighted, actually a lot less weighted in the small cap index versus the S&P large cap S&P 500 index. So, when growth sectors are kind of leading the way higher, small caps are going to lag behind, and that's certainly what we saw today. The VIX coming off about a point, 1.2 from yesterday. So we touched that 20 level. We traded above it, kind of came back down through the close yesterday. Today, pulling back a little bit further. We're back to around 18.5 on the VIX. And again, generally speaking, the VIX below 20, low volatility environment means a market kind of in a steady state, sort of a constructive overall trend. Low volatility, not a lot of excitement. VIX gets above 20, that's more of a high volatility environment. And the VIX usually spikes above 20 in pullback phases. So it's interesting that we've had actually a fairly orderly pullback in that the market has come down to the point it has, but the VIX really hasn't spiked above 20 yet. That certainly could be something, should be something to watch, I would argue, going forward. Now, part of the reason why growth stocks are having a decent day today, or had a decent day, is because the yield curve coming back a little bit. Yesterday, we saw yields pushing higher. We talked about the 10-year yield reaching its highest point since 2007. Came off a little bit today. So the 10-year yield finishing the day around 4.74%. 30-year yield around just below 4.9%. 5-year yields around 4.7%. So still pretty elevated relative to where we've been recently, but coming off from yesterday's hike in rates. And so bond prices actually rallying today. A lot of red on the page of commodities. Besides natural gas, the UNG and the positive, everything else basically in the red. And note this one, the USO is down over 5% today. Crude oil prices really getting hit, and the energy sector, one of the top performers in 2023, and it's not really close from the XLE to kind of everything else in terms of the strength that we've seen recently, right out of the, certainly since the summer peak. Now we're starting to see energy stocks give back a lot of those gains. Charts like DVN and FANG rotating lower very, very quickly. What's happening is crude oil prices have been going up consistently. Now all of a sudden taking quite a bit of a break. As a result, here in the last couple of weeks, you're seeing one of the leading sectors, energy, starting to struggle. We'll try to spend some time looking at that here because there's some potential breakdowns to pay attention to. Finally, cryptocurrencies, kind of a mixed bag. Bitcoin spiked here in the last couple hours, so currently around 27,600. Ethereum prices down about 0.9% from yesterday to around 1640. The Sam Bankman-Fried trial going on, probably the biggest news in cryptos today. No real surprises, sort of recapping what I feel like has been covered pretty widely, but certainly reinforcing the challenges of the cryptocurrency space, right? The upside potential for cryptos, I would argue, is based on a broader adoption of Bitcoin and Ethereum. And when there's a sense of instability in those markets, it doesn't help that sort of long-term thesis. We'll see how cryptos can come out of that. For now, Bitcoin and Ethereum remaining relatively range-bound in 2023. Looking at sectors, the XLY really getting it done. Now, Tesla was up big today, and that's what's propelling the XLY to the top of the leaderboard. Up about 2% for the XLY. The XLK technology up 1.2%, followed by materials and real estate, both up about 1.1%. On the downside, as I mentioned, energy really getting hit today. Oil prices coming off, and so the XLE down 3.3% just today. Utilities were down slightly, and after that, you have industrials and healthcare up about 1/3% from yesterday's close. Let's go to a daily chart of the S&P 500, just sort of see where things are at. Again, on a chart like this, I always almost naturally lean back in my chair, and I would encourage you to, if you can, take a step back from your monitor and just look at the overall trend, right? What stands out at you, to you as you're looking at this chart? And for me, it's a clear rotation, right? And it's just the simple fact that we kept making higher highs, and now we have stopped doing so, right? We attempted to make a higher high at the end of August and failed. And now we are starting to make lower lows along with those lower highs. So lower lows, lower highs, Charles Dow, basic Dow theory downtrend is what we're now experiencing with the S&P. And the way that I would think of markets at any point is what I would call the primary trend. What's like that main trend for the time frame that's of interest to you? So for me, looking at the pattern of highs and lows, I see the primary trend as bullish, really from November of last year through July of this year. And now I would say the primary trend is down because we made lower highs and lower lows. And now what do you do in this environment? Well, you can do a lot of things to try to anticipate a bottom. We'll look at breadth indicators here in a minute, see what sort of signals we can find. You can look at support levels like the 200-day moving average. And I would argue we're near probably the most important support level, right around 4180 to 4200. That's the 200-day moving average. That's the first Fibonacci support level if you take the October low to the July high. So we're kind of there. This week, I would say we are actively testing that 4200 level. That level holds, and this feels like a pretty decent, reasonable pullback within an uptrend phase. And it would tell me that that longer term trend is still positive, and this is just a pullback. We break below 4,200, we might just go a little bit further down and then recover, but overall it opens up the door to being a much more significant downtrend, right? It opens up the possibility that this is just the beginning of further deterioration. So that's what's important about those lines in the sand. It gives you a level that as long as we hold it, things just aren't getting that bad. But if we fail to hold the 200-day moving average, it's not just me, a lot of my peers in the industry kind of focusing and keying in on that level, which tells me a lot of people are looking for support. And if and when that support fails, that's when things can go down pretty quickly. That's when you can have a sort of a waterfall decline. So the S&P below the 200-day, the VIX above 20, that's sort of the perfect storm of bad that we could observe through the course of this week. That's what I would be looking for, and I would encourage you to do the same. Now, in my Mindful Investor live chart list, which anyone can access through the Stock Charts platform, a couple breadth indicators that make sense. I mean, first off, just to think about breadth, and we're going to do a segment a little bit later in the show today called It's All Relative, where we're focused a little bit on individual stocks that tend to do well or are doing well given the market pullback. But let's talk about how we can define the pullback, not just in terms of price deterioration, but in terms of breadth deterioration. Breadth analysis or breadth indicators are really powerful because they are equal weighted measures for the most part. Almost all of them are. And what I mean is the S&P 500, the NASDAQ 100 are capitalization weighted or cap weighted indexes, which means the mega cap stocks, the Teslas, Amazons, Nvidias, Apple, Microsoft types of names have a huge impact on our major benchmarks. Equal weighted measures of breadth completely take that overweight away because they're equal weighted. Amazon has the same weight as the smallest mid-cap stock in the S&P 500. They have the same weight on these equal weighted measures. That's why breadth conditions can be so helpful, because a lot of times the index will do one thing, but the breadth indicators are often a true representation of what's happening to all the stocks that comprise those indexes. Just like we saw with the S&P, all four of these advanced decline lines are making lower highs and lower lows since the July peak. All four of them are now below downward sloping 50-day moving averages. When I'm asked about this market and how to make sense of it, I would say it is totally reasonable to be patient in this environment and wait for this sort of pattern to change, right? Get optimistic when the advanced decline lines stop going down, when they make higher lows and not lower lows. Get excited when the 50-day moving averages are sloping higher, which tells you the trend overall is improving. That's not what we've seen here in August into September. And now as we begin October, these are advanced decline lines showing distribution and telling you that for now, we're not really seeing signs of bottoming. Now, a couple of my conversations recently, Tom Boley in particular, we talked about capitulation. Go back to that interview, by the way, if you missed it just a couple weeks ago. It was really interesting talking about what sort of patterns we've seen at previous market bottoms going back the last couple years. And usually there's been some capitulation event, some constructive candle patterns, some test of key support that is held, some way that we've identified an end to that downtrend. I would argue I don't think we've seen that yet, but we could be there as we test the 200-day moving average, which is why I'm laser focused for signals from candle patterns or something else that would suggest a short-term rotation. One of the other things we could do is just look at breadth conditions, right? And so one of the indicators that I'm looking at is the percent of stocks above their 50-day moving average. Got down to single digits yesterday. It's up to around 11%, but again, still very, very low. Now, if you look back at previous market bottoms, the market has often bottomed with this indicator going down to single digits. What you have to be wary of is it can often go below there and then stay very low for an extended period of time. And that's why just getting down to a low level on its own is not a very good buy signal, because you might be way too early during a downtrend phase. But it does tell me we've gone down a lot. A lot of stocks have gone down a lot. And the fact that 9 out of 10 S&P stocks are below their 50-day, now I'm looking for that capitulation event. I don't think I've seen that yet, but that's what I'd be looking for. And again, with advanced decline data, you can keep it simple. Look at the McClellan oscillator. This is one of my favorite tactical measures of market strength or weakness. Very simply, when the McClellan oscillator is above 0, the trend is constructive. When the McClellan oscillator is below zero, the breadth indications are more bearish. We saw this rotation below the zero line here in early September, right around Labor Day. From there, it's basically almost 100% of the time been below zero. And what that tells you is the trend in the advanced decline data is bearish, and it's more similar to bear market phases, corrective phases, than bullish phases. What do you do in this environment? Quite simply, you're looking for this indicator to break above zero. If I were you, I would set an alert on the stock chart platform for when this index $NYMO gets above zero. We check at the end of every trading day to see the latest data once we get the official closes. Look for the day when that breaks above zero. That could be the signal that we are now in a recovery phase. And if you look down when the indicators gone back above zero, it's not like way late. It usually happens pretty early in a recovery off of those swing lows. So now that we're in a downtrend, I'm looking to see when the advanced decline data turns more positive. Not seeing it yet. To finish off here our market recap, let's look at the energy sector. As I mentioned, let's not get too excited. It's still pretty brief in terms of the pullback. If you look at the XLE, just 3 days ago, right, last week, we're testing new 52-week highs for the XLE around $93. We've come down quite a bit. And the problem I have with the energy sector here is that crude oil prices are coming down so much. The XLE in a lot of ways is a direct play on crude oil prices. I still would argue that the long-term trend in commodities, in materials, in energy is probably pretty optimistic. We're seeing a pullback after an incredible run higher in oil prices. And if you look at something like the USO or $WTIC is the crude oil future price that we can look back over time. What's concerning about something like the USO is we're breaking down below trendline support. So that's often an early warning that things are starting to rotate. Now, what you're not seeing is any real breakdown yet, right? Today, we're closing below the 50-day moving average. I would look on the chart of the USO to see if we get follow through on Thursday and Friday session. That could be a good validation of a breakdown. If we do break further, remember we have to get all the way below 70, right? We have to get below the August low to complete a rotation more to a bearish trend because it's been in such a good uptrend. Or we rally and make a lower high. Those are the kind of things that would tell us more about a broader rotation. For now, this feels like a steep pullback within an uptrend until proven otherwise. Again, testing the 50-day. So I think it's important to watch crude oil prices here going through the remainder of this week. The problem is that is forcing that quick sell-off that we saw in crude oil is causing some downside pressure on energy stocks. And if you look at the relative strength in energy, July, August, September, in the third quarter, the strongest sector, I believe, out of all 11, with a nice stretch of relative performance, relative outperformance, coming off a little bit as the price is going down. Watch the momentum just today as we went down another 3%. The RSI is getting just below 40, and that's often one of those kind of simple measures that I do to say, is this just a brief pullback or something more significant? So cause for concern, I think, on energy. And what concerns me as well is the signal that we saw August into September, higher highs in price, lower peaks of momentum. That's that bearish momentum divergence we've often highlighted, maybe playing out exactly as we would have feared with something like the XLE. That's it for our market recap. Again, focusing on a nice recovery day. Breadth conditions, I think, still pretty negative. Worth focusing on those to see if we can track a bounce off the 200-day moving average. Do we see those breadth indicators recovering from their downtrend? Not yet by my reading. We're going to come back here in a minute with our next segment, It's All Relative. Before we do so, a couple quick announcements. First off, we welcome your questions. We're going to do a mailbag probably at the beginning of next week. I think on Monday show will be our next mailbag. We would love to answer one of your questions live on the air. We had so many great questions from our live Q&A earlier today. We will include some of those in our next mailbag, but we could always use another question or two. What are you running into as you are analyzing the markets, as you are using technical analysis, as you are using the Stock Charts platform? Our email is thefinalbar@stockcharts.com. We're on the Twitters @FinalBarSCTV. And of course, on our YouTube channel, just put a comment below the video you're watching on any of our live broadcasts, like this one right here. Just put a comment in the chat. We'd love to get your questions. At some point, we'll probably start looking at those questions real time during the show. But for now, we will happily put those in the mailbag and watch to make sure your question gets answered in our next mailbag segment. I mentioned our live Q&A. We held that every Wednesday, 1 p.m. Eastern. So we did one earlier today. It was a lot of fun. We touched on a number of different charts, one of which I'll show. I think one of my 3 and 3 charts came from the Q&A today. So thanks again for participating. We had a lot of really good questions that came in. Won't you join us in our next interactive live Q&A? That'll be next Wednesday, 1 p.m. Eastern, here on our YouTube channel. Let's continue on with our next segment. It's all relative. I was talking to my market misbehavior premium members earlier today, and was asked about, what types of stocks do you look for in this sort of environment, right? When it feels like everything's going down, when it feels like everything's struggling, where do you look? And I would summarize it in probably two main areas, right? And the overarching theme is you want stocks that are showing strong relative strength, meaning they are outperforming the benchmark. And that either means they're still going up or they're just going down less than the benchmarks. In either case, it's probably a good place to be when the markets are in a corrective phase. So the two general buckets of stocks I like to look for are stocks still going higher and stocks not going down, right? Because so many things like Paramount and Disney and others are just in these established downtrends. What's not breaking their recent swing lows? What are still going up? Let's hit on some of the charts that fit those criteria. I'll start with Murphy USA, right? And not to keep pounding the table on this one idea. I know I've mentioned it on the show before, but I just feel so good that this cup and handle pattern worked magnificently. I was recently on the podcast Investing with IBD, and they asked for a good example of a chart I was watching, and I mentioned MUSA because it is a cup and handle pattern, which is one of William O'Neill's kind of famous patterns that he popularized in the industry. And that's when you have a run higher, you have this big rounded bottoming pattern with a similar resistance level, then have a shallower pullback that tests resistance and then breaks out. And that break above the rim, ideally on stronger volume, tells you that there's a period of accumulation and buyers are willing to pay more for this stock than they have in quite some time. It has followed through beautifully to the upside, overall continuing to go higher. What concerns me on this chart? The bearish momentum divergence. I always would much rather see stronger momentum as we make new highs than lower momentum. But again, the reason why the relative strength is improving is because it is going up when most stocks are not. And that's why I think a chart like MUSA still probably deserves your attention at this point. By the way, MUSA was one of the 10 stocks that Grayson Rose and I featured on our top 10 stocks to watch for September 2023. This Friday, we will be sharing our top 10 stocks to watch for October of 2023. So if you like this sort of idea, tune in on Friday's show. We'll probably have some other good ideas of charts on the move and charts with some actionable points and patterns to pay attention to. So what other types of names can we look at? I would say other types of names that are probably outperforming are stocks that are not breaking down, right? So Alphabet, probably the best example of this particular type of pattern. When the market is going down, right, when the S&P and the NASDAQ made a high in late July and then August, September starting to roll over, still in questionable trend, but I would say overall more down than up, look for things that are still making higher highs and higher lows, or at least not making lower lows. And that's where something like Alphabet comes to mind, right? Alphabet has held its 50-day moving average a number of times. What's most interesting to me in the last couple weeks is that we pulled back to this level of support from August. And what's so interesting is, remember, when a stock pulls back to a pretty established level of support and holds it, that tells you something, right? When it pulls back to support and fails and breaks to a new swing low, all of a sudden this is a lower high and a lower low, and that's a Dow theory downtrend. This is what a head and shoulders top kind of looks like before it becomes a head and shoulders top, kind of looks like this. But holding that neckline, holding that level of support is so crucial. That's really the key to that pattern, is that you stopped making higher lows and now we're starting to make lower lows. In the case of Alphabet, it's holding support. And this level of support lines up beautifully with the June high around 127, 128. You can see we tested this level a number of times in August. We made a new high for the year, then pulled back to that same level of support. So as long as that level holds, I think this chart is still pretty good. Now it's up 2%, outperforming on an up day, still holding an RSI of 40 on pullback. So it's still showing you the bullish signs while a lot of charts are not doing so. And again, focus on the relative strength going up. Again, charts where the relative strength is improving is usually a really good place to be. NVIDIA is a very similar chart to Alphabet at this point. Same in that it's pulled back to an established level of support and has held. So again, at a time when a lot of stocks are failing to hold a support level, I'm interested to find ones like NVIDIA that first actually established 400 as resistance back here in late May. We broke above there in June, tested it in late June, tested it again in early August, tested it again a couple weeks ago, and now we're still above there. So, NVIDIA above 400 is not a bad chart. I would argue it's still a constructive chart. Now, it breaks below 400 and breaks this level of support, I would argue all bets are off, right? I think that suggests that it's now making a lower low, and maybe you want to think about downside protection. But for now, it's a stock holding support. That's why the relative strength line is holding up as well as it is. So I think those types of charts can be pretty constructive here. Now, other things to look at in this sort of idea when you're looking for stocks that are outperforming, the other one would be names that, again, that are not breaking down. And so testing support would be one thing. Consolidation patterns, basing patterns, right? A chart like Tesla making lower highs and higher lows. It's not breaking out. It's not making new highs yet, but it's not going down, right? It's not. It's holding support, and it's not testing those support levels, right? We're actually making higher lows from August into September. The problem is we're actually making lower highs from July into September as well. So this is that coil pattern or that symmetrical triangle pattern, basically telling you it's at an equilibrium point. But the relative strength line is overall trending positive because this is a stock that's not breaking down while the averages are actually failing to hold their previous support levels. So I think Tesla is a good example of that consolidation phase. Now, what do you do with a chart like AMD, right? Something that actually is going lower. And unfortunately, a lot of stocks kind of fit this criteria. And I'm avoiding things like Disney and Paramount, not to just continue to use communication services names and entertainment names as like the punching bag of example. They're just obvious examples in my head of charts going down consistently, right? So these types of charts, in my opinion, you touch them until we see signs of accumulation, until we get above the 50-day, until we see an improvement in momentum, until we see higher lows, until we see some sign of accumulation, improvement in relative strength. Why waste your time looking at a PARA or a Disney? I would argue not a great idea. Something like AMD is a little different because it was so strong October into really May, June, but now we've pulled back quite a bit to the 200-day moving average. So when you have a stock like this that's going down, you have two options. Number one, buy weakness, right? Buy when it's testing support like the 200-day moving average. I don't have a problem, honestly, with taking a shot at an AMD here because you're basically saying it's down a bunch. It's pulling back to an established level of support where I would normally expect support at the 200-day moving average. It's actually bouncing off of there. So I don't mind taking a position here, using that as my stop, either the 200-day or the September low, and betting on some sort of recovery. And if we recover, I feel like a rock star buying in at this weak point. If we continue to go lower, my downside is limited because I'm going to minimize my losses to a break below that level of support that I would probably anticipate. But overall, I would much rather be patient and wait for this to improve. So what do you use to identify that not just it might go higher, but that it is going higher? A couple options. Number one, you wait for it to break above the 50-day moving average, right? Below a declining 50-day moving average is a chart in a downtrend. When do we break above there? That might be an alert to set. Second option would be using something like simple trend line analysis. So on a chart like this, just take the previous highs. So here you can see a trend line starting with the June high. Look at how that lines up with August, again in September a couple times, and now again with where we're at today. That lines up really well with the 50-day moving average as well. So this is a chart now going lower, lower highs, lower highs, lower highs. When does that pattern break? When do we break above that trend line? That might tell me that at least the definition of the trend that I've been set with is now starting to change, and we're seeing signs of accumulation. The last option I would say would be use an indicator like PPO or MACD, the PMO, which is something that the decision point folks like to use. Indicators like this are designed to capture rotations higher after a period of decline. If you look at some of these previous lows, the PPO indicator going well below the zero level and then crossing above the signal line often coincides with the end of that decline. We're actually just getting a buy signal here this week. Does that tell me that this is beginning of something a little bit further? Perhaps. So I would say some combination, maybe one or two of those indicators that I just shared can help you track the downtrend in AMD, anticipate support from an indicator like the 200-day moving average, but I'm happy being patient and waiting for a break higher, waiting for a sign of accumulation. One of those three approaches, using trend lines, using something like PPO, using a break above the 50-day moving average, those would be some of the indications that maybe this downtrend phase is exhausted and we're starting to see a period of accumulation. By the way, if you're looking for ideas of how to scan for ideas in this sort of environment, one of the basic scans that I like to run, and I actually just call this Correction Long Ideas RS, it's super simple. What I'm doing here is saying I'm looking at the S&P 500, so of course you can customize this universe to whatever. This line right here is the most important line to use. And what this basically says is it's saying percent relative 20 days S&P. So this is saying show me stocks that have had this relative performance versus the S&P for the last N number of days, and it's over 10%. Of course, you can make that anything. Just show me stocks that have outperformed over the last month. Show me stocks that have outperformed by at least 5% over the last 20 bars or 40 bars, whatever it is. By using this particular line and customizing the parameters, you can focus in on charts that are working on a relative basis. That's one of my favorite ways to scan for relative strength using the Stock Charts platform. In this particular environment, it's all relative. Focus on the stocks and ETFs able to outperform during a negative tape. We got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of the market environment. Let's get to chart number 1. A colorful way to describe the market activity, the McClellan oscillator. And again, this is a color-coded chart that I started setting up a while back, and I've just enjoyed so much watching it track the market just brilliantly. This is based on the work of Sherman and Marion McClellan. Tom McClellan, who is has continued their work with his own, continued to write a newsletter for a number of years. His parents developed this McClellan oscillator as a way of taking advanced decline data and just getting a short-term read on momentum based on that advanced decline data. When the McClellan oscillator is above 0, the advanced decline data is bullish. When it's below 0, it's bearish. It's really based on the change in the advanced decline data over time. The section shaded in red is when the McClellan oscillator has been below 0. You can see how that pretty much captures the price corrections and the time corrections, like we saw in April, May of this year. Overall, avoiding the market when the indicator is below 0, being long or thinking more on the upside when the indicator goes back above 0 has often been a really successful strategy in up markets and in down markets. So if you're looking for this downtrend to be over, as I feel like most investors are, this is one of those indicators I think is super helpful. Just sit on your hands, wait for this to go back above 0. That can often be a good indicator of a rotation from a pullback phase to more of a resumption of the uptrend. Chart number 2 in our live Q&A earlier today, and again, I would encourage you to tune in every Wednesday at 1 p.m. Eastern, 10 a.m. Pacific for our live Q&A session on our YouTube channel. We were asked about TTD, which is Trade Desk Technologies. And if you look at TTD, this is in the financial sector, classic example of a coil pattern. That's when you have a run of some sort, and then you have this consolidation of lower highs and higher lows. Tesla in the top panel, the exact same pattern, right? They're actually very similar charts right now. 2 different stocks, 2 different industries, but the charts look very, very similar. What's great about this particular pattern, it's about as simple as you can find in the technical toolkit, because what this is telling you is that the market's consolidating around an equilibrium price, around $255 for Tesla, around $80 a share for TTD. What you do is you wait to see where we break. Either we break above the upper boundary or break below the lower boundary. Whichever way we break, that is often the new direction of momentum that you probably want to follow. Nice rally for both of these stocks today, but still within that consolidation phase. Get excited when we break out of that coil. That can often tell you the new direction to expect. Chart number 3, crude oil prices coming off quite a bit. We've talked a lot about the energy sector, particularly in the third quarter, one of the strongest places to be. A big downdraft for oil prices and for energy stocks here in the last week or so. When I'm looking at the USO, I'm concerned that we've now broken below a trend line using the recent lows over the last 3 months. That really tracks the uptrend in oil prices. And now this breakdown that really punctuated today with the USO gapping lower and closing down about 5%. We're now testing the 50-day moving average. We're now testing that first 38.2% retracement right around $75. Do we hold here? Does the RSI hold right around 40? And if so, that could signal a resumption of the uptrend for energy. Maybe this is a pullback. We break down further, though, and this is going to cause the relative strength of energy. This is the XLE, the energy sector versus the SPY. Look at how the relative strength has broken trend line support as well. You can use trend lines and other technical indicators on relative strength lines as well. I'm concerned by this breakdown. I am a big fan of owning stocks that are outperforming. The movement in the last week tells me energy may not be one of those going forward. That's it for today. Thanks so much for joining us every weekday after the close. Don't forget to check out some of our previous interviews, some really good ones. Yesterday, Elliott Wave 101 with Jeff Hughes with some interesting downside targets. Lots more great interviews here on our YouTube channel. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.